Yeah, just talking about the Canadian housing market again. Again, this is an ongoing issue with most media publications. According to National Bank, Canadian house price trend very similar to U.S. just before it crashed back in 2008. And I'm not saying I'm the only person that is thinking this way, but obviously, it's in the mainstream media. And people will always say, whenever there's some sort of a crisis, financial crisis, well, why didn't anybody see it coming? That's the first thing everybody says. Well, there's a lot of people that see it coming. The analysts at National Bank wrote an article again. Canadian house prices, like I said, trend very similar to the U.S. before the crash. They have these charts showing the price of existing homes in Canada versus the U.S. Just look at this. Just look at if you juxtapose the two. The United States, their houses are under, again, on average, $200,000. Now, the Canadian houses are averaging over 300,000. And you got to remember, like, obviously in places like Vancouver, Toronto, Calgary, the major cities, $300,000 is low for houses. But don't forget, there's a lot of rural areas and so on and so forth, where if you average them all out, it's over 300,000. So that's $100,000 difference between the United States and Canada. That's a huge difference. That's not just a marginal difference. And what you're starting to see, I think, some of the, again, some of the main indicators here are the, let's call it for what it is, the less desirable cities. They're starting to see huge growth. Now, why I think that is an indicator is because people have basically given up on the major cities. They can't afford Toronto. Toronto's $1 million for detached property. A lot of semis, townhouses are going for $1 million. So people basically just, have admitted defeat of living in something like that, and they've just, decided to look elsewhere. But if you look at these other cities, like Brantford, I actually used to live in Brantford. That's where I bought my first house. And believe me, I don't think anybody by choice wants to live in Brantford. They're seeing houses rise by 17.4%. Guelph. Now, Guelph's a nicer place. That's going up 16.7. Look at Hamilton. Who wants to live in Hamilton? That's going up by 19%. That's an incredible rate of return when you're talking about, when money, you'd be lucky to get 1% from a bank, and you can get close to 20% with a house in Hamilton. And then you have St. Catharines. What jobs are there in St. Catharines? That's 23.9%. So, in Toronto itself is obviously still seeing seeing their prices go up. But I'm just saying that when you start to see these smaller, less developed, less desirable type cities going up, again, it's just that the bubble's just spreading there. And I think it's a mass migration of people from the bigger cities going there. They're trying to find something more affordable, and they probably have in the back of their mind that it's going to be like Toronto. It's going to keep going up. They're probably thinking to themselves, I can get something for 300 grand. We saw that in Hamilton. You could buy a house for like 240. Now that's probably like 400,000. So people are it's a self-fulfilling prophecy. If everybody starts doing it, it'll happen. Now again, you got to look at, again, the bigger picture of what's going on. If you look at, again, the energy stocks, and as much as people like to think Canada is like a technology-driven country, it's not. It's still basically a resource-based economy. And if you look at the energy stocks weigh on TSX as crude prices hit 7-month low. So what's happening right now is the Trump administration is they're opening up all the oil fields. Obama shut a lot of them down, which drove prices up. But Trump's saying, turn on the tap, let all the oil flow. So that's bringing the prices of oil down, which is harmful to somewhere like Alberta. And when I was working in Alberta, I worked as a financial advisor for one of the big five banks, and I had a lot of clients that were executives for the oil industry. And one president of an oil company told me, he goes, if oil goes below $60 a barrel, uh, the oil fields in Alberta don't make any money because it's very expensive to refine Alberta oil. It's very dirty. It's tar sands, right? So they have to spend a lot of money refining it in order to make it usable. Whereas like in Saudi Arabia, the oil is very clean. So that's why they can sell it cheaper. He said basically you can put a pipe in the ground in Saudi Arabia, take it out, and it's diesel fuel. Like you can use it almost without any sort of you don't really have to refine it. There is they refine it to a certain degree, but it's much cheaper than anything they get from Alberta. So the prices of oil, if you look at them right now, they're like in the mid 40s. So yeah, so they're talking like it's hovering around 40 to 55, right? So that's below cost of what it takes for Alberta to make money. Now, again, I've said this before, and I'll just reiterate on this, that people say, oh, when the States had its crash, it didn't affect Canada, but oil was at like 140 plus a barrel, right? So they went over their threshold by almost $100. They like $80. I think it was close to $90 at some time over that $60 break-even point. So, but now it's below the break-even point. And again, Canada is very, their economy is very contingent upon commodity prices, especially oil. And it's not looking good for oil right now. So the main topic today, though, is should you use a put option on a Canadian exchange? Or I was thinking, actually, it would be probably smarter if you went to the New York Stock Exchange. Like if you bought an American put. And I'll tell you why, because if the Canadian economy does crash, the Canadian dollar will go down as well. So if it's hovering like right now around 73, 74 cents, could you imagine if it goes down like to 50 cents? So you could make like maybe $40 or plus or $50. In my other example, I was saying it could go down as much as like $80 a share from what it currently is right now. Plus, you could also get maybe like a 25% bump from, a foreign exchange differential. So if the Canadian banks do crash, you can sure as bet that the Canadian dollar will crash too. So if it goes down like an extra 25%, plus you get the crash of the bank stock itself, you might be better off actually to go and get an American put on a Canadian bank, because like the New York Stock Exchange does have Canadian Imperial Bank of Commerce, has all the Canadian banks. They're interlisted. And for those of you that don't know, like interlisted just means you can have like a Canadian stock, but it's also on the New York Stock Exchange plus the Toronto Exchange. So you can have your stock on multiple exchanges. So what you might want to do is throw a put. Right now it's trading at 80.02 as of June 20th, 2017. So you could buy like a put below 80. Now, obviously, if you do the exchange and do it in Canadian money, it's going to cost you more than that. But that would equal approximately $106 Canadian. But like I said, but you're also going to make money on the exchange differential, which could be a benefit. So you might want to buy the put in American. So that's just a quick heads up for today. And again, so what you want to keep in the back of your mind is if I'm going to throw a put on a bank, preferably CIBC, as I said, it has the highest domestic mortgage book out of all the Canadian banks. They have more exposure to Canadian housing. So that would probably be your best bet. But I would imagine they'd all fall. But I like this one just because it has more potential to fall. So again, that's just my take for today. If you have any questions or comments, please leave them. Thank you.